Hi YouTube, it's Shameli here. I've been posting recently a lot about investments and investing in general. And I've talked a lot on my channel about investing and specifically investing in retirement because that's the biggest type of investment that I'm doing right now. So I just wanted to kind of put this video together to share the best kind of rules and tips and tricks that I've read about over the past few years and that I've definitely decided to follow these rules because I think that it's kind of coming up over and over again in the research for a reason. I mean, if a lot of the most successful people are saying these things, for me, that kind of rings a bell like, okay, write that down, girl, that's probably important. So yeah, I just basically have a list of the things that I have learned over the years that I've kind of noticed, I've heard over and over. And I just wanted to share those rules with everybody on my channel so that you guys can go ahead and find out if these are things that you might want to start considering if you're not already incorporating them in your savings and goals in your financial plan. Before I jump into those rules, I just want to remind you about my Patreon page, which is linked below in the description box. Please go check it out. And if you have it in your heart and in your budget to give even just $1 a month, it would really help me to put those funds towards creating more content right here on my channel. Okay, so let's go ahead and jump in. The very first rule to follow is to always accept the company match if you get one at your job. This is specifically talking about retirement, which is, fine. I mean, everybody should be doing retirement investing, especially in your 20s. If you haven't watched this video, click on it now. It's so important that, young folks start investing in retirement as early as they possibly can to take advantage of compound interest. But yeah, I mean, I think that if your company is giving you free money, then you should definitely take it. At least contribute up to as much as you have to get that full match, and then you can put your money elsewhere after that. Another way that you should consider investing for retirement is by maximizing a Roth IRA every single year. You can maximize that account by putting in $5,500 a year if you're single right now. And there's different amounts for you if you're married. And if you make more than, I think it's like $118,000 in 2017, then you can't, you kind of start getting phased out and you don't qualify for it. So just find out kind of where you are in all of that. And if you can invest in a Roth IRA, then you definitely should, because it's a really great resource. So go ahead and kind of look into the Roth IRA, and if you can afford to maximize it, that's definitely one of the rules that I've seen come up over and over and over again. Come up with the exact number of amount of money that you want to have when you retire, or how much you think you will need to retire, because that's going to be your goal. And if you don't have a big goal, then you're not going to kind of know where you're going. You're just kind of saving up money and you don't really have a plan, or you don't really know how close you are to reaching your goal. So it's really important to know. And a lot of people just kind of say, I don't know, am I supposed to just make up a number, $1 million, $2 million? I don't know how much I need to retire. And so here's the rule for that. You definitely want to have a very specific number. So take the amount of money that you think you will need to spend in a year when you're retired and multiply that by 25. So if you think you're going to spend about $50,000 a year, say you multiply that by 25, you're going to need $1,250,000 in order to retire. So yeah, you better start saving now. Another rule that I keep seeing over and over again is not to be too conservative with your investments, especially when you're young. You want to get more and more conservative slowly as you get older and closer to the age that you're going to want to retire. But when you're young and you have a high risk tolerance, it makes sense to, invest a little bit more in higher risk investment options. So the rule here is the number 120 minus your age. That is the percentage of your investments that should be stocks. So for me, 120 minus 27 equals 93. So right now in my Roth IRA and in my traditional IRA accounts, I put my allocation to 93% stocks and 7% bonds. And when I turn 28 or 29 or 30, then I will redo the math, 120 minus 28, and then I'll go ahead and do 92%. And slowly I'll start to pull back how much of my money is invested in stocks so that, it's less and less and less risky. And if you want to know more about stocks versus bonds, you can check out this video, which I recently posted, that kind of breaks down the difference between the two in very basic terms. funds. This one's going to sound pretty obvious, but you'll be surprised how many people, don't know the rule or don't follow the rule. So this one is, don't invest in anything that you are not 100% sure about. Just avoid any investments that you don't understand. This one is really important because if you're not 100% sure about all the details or about what someone is trying to tell you regarding an investment, then ask for more clarification, or don't make a quick sudden decision without the information, because you'll probably come to regret it later, unless you get lucky, and that's kind of gambling, and you don't really want to gamble with your money. It's better to be 100% sure before, and be really confident before you put your money on the line. And if somebody's telling you like, oh, you have to do it today in order to get the benefit, you have to put your money down now, it's a one-time thing, it's a deal that I'm offering you, and they're using fancy words and putting pressure on you, and they don't really want to explain it in a basic way or put it in a way that you would actually understand it, then be cautious, because that person probably scamming you, and it's just not smart. You don't want to gamble away your future money, like the money that you're saving for your future. So just stick with the plan of getting rich slowly, and sort of saving consistently over time, and it'll definitely pay off. Avoid high fee funds. So this one is definitely something that is easier to do now than it was before. With like robo-advisors and like technology that exists today, we're really, really lucky that we have all these different low fee options, especially for funds like index funds and ETFs and things like that. So I think this one has gotten easier over time, but just in general, there's still so many different people out there who either don't invest, or they're afraid to invest, or the person that they invest with is giving them wrong information, or giving them bad advice. And so it's really important that you remain aware that there are some really low fee options out there that are trying to help people make the most of their money, and that's kind of the smarter way to go, especially over time. The highest fee right now that you should ever consider paying for a fund is 1%. And that's pretty high. I mean, I feel like there's a lot of available options out there where you can pay just even a fraction of that and get really quality funds. So yeah, your goal should just always be to find the high quality funds for very low fees. All right, those are all of the rules that I have collected over the past few years about investing. If you follow these rules, you will be on the path to building wealth, and you'll have, a lot of money if you stick with it and you kind of keep these rules in mind over time. Just kind of always keep in mind that when it comes to retirement investing, and when it comes to investing in general, especially when it comes to the stock market and bonds and things like that, it definitely is all about the long game. You're not trying to make a quick buck, and if you are, then you're gambling, right? So this isn't something that I recommend gambling with. It's something that you really need to make a plan and kind of stick to your steps that will get you on track to your plan. And hopefully, if you do that consistently, then you'll be where you want to be, if not exactly when you want to get there, earlier, because that's always nice, right? To meet your goals before you planned to meet them. If you guys have any comments, or you want to add anything or ask anything, put those in the comment box below. Please subscribe to the channel if you haven't done so already. And if you want to message me privately, you can do that at MissBeHelpful@gmail.com. Till next time.